Welcome everybody to another 144 and 360. Even though we just do the grain markets in our weekly analysis, we like to show other markets and how the Fibonacci retracements work in them, just to prove to you how they, or what we believe is the underlying structure of all markets. We're going to start here with the daily chart. We've done other videos on this and you can go back and take a look at them. But we're going to start here with this high that hit 61.8 up here a few times, and also a longer term 23% back to the all-time high, where you only had one close, well, a couple close, but never two in a row higher to get through any of these levels up on top. How the market went 61.8 to 61.8 down here, eventually down to 78.6. and how the market stopped at 38 and 38. But more importantly in this one, I want to take you into not only this move down, we'll go through on the hourly chart or a 2-hour chart, but more importantly this move right here. It doesn't look like much other than just going down, but we want to show you just how important the retracements are and how they work and how they guide you as to how good the market is, or how weak, how good, how strong, how weak the market is. So we're going to go into, this is a custom intraday chart here, and we start up here. This was the 61.8 level we pointed out up there. The first turn, the first move down, 78.6. Now this was still an uptrend at this time, and the failure to make that new high up here that came at exactly 78.6% tells you that there's a good chance the market's turning. So as you can see here, it really did turn, and then we take our next move down here, and you can see that we hit 38%. Now 38% rule, any market that's going to keep its direction is going to stay below 38% or above, depending on the direction. In this case, what do we look for if it holds it? New lows. And in this case here, you can see that we didn't make a new low here, but what we did have here is if we did this retracement then back here, because we can't go back to here until this low is taken out. So you can see here 38% is what stopped this market. This is like an hour above that level and then back below it. So now it did make a new low. We can go back to this high up here and we retrace down, and that 38% did send it to a new low. Now we come up to 23.6 and couldn't even get up to it, fell short of it. And we know the 23% rule is when markets are in runaways or extremely weak or very strong. In this case, you can see that it was very weak. This just took it down into another flush out down here where we hit that 78.6 level on that daily chart. Now we bring in the levels down to here, and we can see once again back up to this level, the extreme, two extremes. 38.2 was right here right at this level, 113 and change. But the more interesting thing is that there's two important highs to go back to. One is the extreme, two is one that stands out, and especially being a 38% retracement brings us to 61.8. So what do we have here is 38.2, 61.8, but the first time we hit, we came off, and the market, what did it do? It held 23%, saying the market's still good. Made a slightly higher high, never a good sign after holding a retracement. We have more on that in other videos and in just our rules and guidelines. Now, the combination of these two things, 38 in itself, should send this market to new lows. That's the bigger focus of this, because this is a bigger move. 38% stopped at it and started trending lower. So we showed you the first setback held 23%, slightly higher high. Then we start to do the retracements here, and it holds 38.2%. So very positive sign for the market, right? I mean, we should be going for new highs. But as always, when we watch all these markets, we have to watch what's going back up. And what did we hit? Couldn't even get through 38% this way. Again, it just shows you, you know, I mean, how important these levels are, both in the big level. Now, this is that move down that we had, but even within this little move, just look at what's happening here with how the retracements are going. So the next move down didn't hit a retracement for Fibonacci, but the rally started and it went once again 38.2%. Now this is just adding to the fact that 38 tells us the new low, 38 tells us a new low, but the bigger 38 is still saying this low over here should come out. Not going to always happen, but that's why we watch all the retracements up on top. So as you see here, when we did this one back here, we've got that the market held 78%, which, you know, when we follow that, could start the whole new bull market in theory. But in this case, where did it go again? But couldn't even get to 38.2%. So you see each one of these things, again, telling us it then should go for new lows. Now you have this low that we're still, because of this, saying it should go for new lows, but then you have it backed up by even hitting levels below it. It could only get to 38 the other way. No reason here, but 38 back again the other way, then 78.6, and again can't even get above 38. So it's just telling, if you use these guidelines and the rules that we set out with the 144, you're going to be able to understand where the strength and where the weaknesses are in the market and what they should hold or what they should take out. And if what they do hold tells you what should happen from them. So it's not just trade at that level, and if it doesn't hold, it doesn't mean anything. It does mean something. And this is what we try and show every time here, just how we believe this is the underlying structure of the market. As we said, we do this in the grains weekly. If you trade the grains, we'd love to see you subscribe to us. We do this in the other markets just to show. We just recently did one on Ripple. It's on our webpage. You can find it there, ONE44analytics.com. Please subscribe to us here on YouTube. Give us a thumbs up. And even better, come and see us at our website. And if you trade the grains, we'd love to see you join. Until the next video, good trading.